In Unit 2, Activity 2, you will explore how promissory notes are used and the accounting transactions related to notes receivable. A promissory note is a written promise to pay a specified amount of money on demand, that means at any time, or at a definite time, depending on how the note is made up. The party making the promise is the maker. The party to whom payment is made is called the payee. Notes receivable usually have interest on them, and that's how the business earns money on these notes. The basic formula for calculating interest on an interest-bearing note is the face value of the note times the annual interest rate, time the times in terms of 1 year, and that gives you the interest on that note. And that is an annual rate of interest. So if you were calculating just for 1 month, you would have to divide that annual rate by 12. For example, Wilma Company receives a 1,006% promissory note due in 2 months from Brent Company to settle an open account. That means that Brent Company was an accounts receivable of Wilma Company, and now they've been switched to a notes receivable because they haven't paid their account. So the company, Wilma Company, can charge them interest for the length of time they're taking to pay it. The journal entry for that is to debit notes receivable and credit accounts receivable, Brent Company. Notes receivable, like accounts receivable, are short-term notes receivable reported and are reported at their net realizable value. The notes receivable allowance account is allowance for doubtful accounts. So on your balance sheet under current assets, you would have notes receivable less allowance for doubtful notes to give you net notes receivable. When a notes receivable is paid, that is called honored. And in this example, Wolder Company lends Higley Inc. $10,000 on June 1st, accepting a 4.5% interest-bearing note due in 4 months on September 30th. Wolder collects the maturity value of the note from Higley on September 30th, and they recognize the revenue earned from that interest. So the journal entry is to debit cash or bank for the total of the amount of the note plus the interest, credit notes receivable because they've paid us, and credit interest revenue, whatever the interest calculates on that note. A dishonored note is a note that is not paid in full at maturity, and these notes are no longer negotiable. Since the payee still has a claim against the maker of the note, the balance in notes receivable is usually transferred to accounts receivable. In this case, Higley did not pay their note receivable at the end of September, so they have to be set back up as an accounts receivable, and the notes receivable is credited, and we recognize the interest revenue. Sometimes these accounts receivable are then sold to an external debt collecting agency to get that money for the company. Good luck with Activity 2, everyone.